Nilesh bhai likes cricket. All of us are, most Indians, as we were discussing, are cricket fans. So Rohit and Virat have retired. It seems that the Indian economy is a bit tired. Would you agree?
That's a very, very poor attempt at rhyming.
I think our economy is anything but tired. In fact, two of the things that I've discovered in the last month or so of research, they've reinforced the value of fiscal discipline, of low leverage. So think about the US. We thought that because the US dollar is the reserve currency of the world, that they have the exorbitant privilege of having unlimited fiscal deficits, that they can spend what they want. But now what has happened is that if you keep doing that, your net international investment position just goes for a toss. So they have had the reserve currency status and current account deficits for most of the last 80 years, especially the last 50 years since the gold peg was broken. But their NIIP as a percentage of GDP, the NIIP, just for those who don't know, is a net international investment position. So the US as a whole now owes $62 trillion to the world. They own $34 trillion of assets, global assets. So the gap is minus 28, which is minus 90% of GDP. This was only minus 20% of GDP in 2012. It is only after that, when they've just gone berserk with fiscal discipline, or indiscipline, that they have really killed themselves. The Chinese are in the same state. The federal debt as a percentage of GDP in the last 6 years has gone from 40% to 90% of GDP. Their fiscal deficit is 10% of GDP. The general government fiscal deficit is 10% of GDP. It is at the same level as it was in 2020. Now, the comparison I make is that if you want to get someone to run, this is the balance sheet view of economics. If you want someone to run a marathon, are you better off with someone who's had a nice long night's sleep, has had good pasta in the night, and is all charged up, or someone has already run 2 marathons and is wanting to run the third one? So both the US and the Chinese economies look very tired to me. Your balance sheet view is very weak. In India, we have low financial leverage, meaning the non-financial firms have very low levels of debt. The government has told you it is going to bring debt to GDP central level down to 50% by 2029, 2030. The 10-year bond yields are continuing to fall. These medicines work over a medium term. They don't work very quickly. So last 2 years, we've come through the trauma, and there's no softer word for it, the trauma of intense fiscal consolidation. We've seen fiscal deficits fall by 80% or 80 basis points of GDP, which is like an 80 basis point drag on growth. The drag this year is 40 basis points. So we are slightly better off. So I would characterize it as exactly opposite of what you're saying, that we are now like with fresh blood, a lot of enthusiasm. We need some demand catalysts. Hopefully the interest rate cuts that are now underway, the liquidity easing that is underway will boost credit demand. And in 3 to 4 months' time, some high frequency indicators should start turning.